2025 is the year of being healthier for Bay Area and Silicon Valley real estate. I'm Olga, and today I'm going to walk you through what actually happened and what that means for you going into 2026. Buckle up. We had a measured market in 2025. Not a crash, not a rocket ship, but a healthier, more balanced pace. Let's break it down into interest rates, inventory, sales volume, market activity, prices, and tech salaries, seasonal trends, new construction, and investment and rental markets. Let's start off with interest rates and buyer sentiment. For most of the year, we lived in the 6.4 to 6.7% range, give or take some weekly wiggles. And as buyers realized sub 3% was history, more of them stopped waiting for a miracle and started making moves. Rates calmed down enough for people to emotionally normalize and be engaged. Let's shift to inventory. Inventory did increase enough for buyers to actually have choices again, yet nowhere near a true buyer's market, especially in core Silicon Valley and similar high demand areas. More selection, a bit less frenzy, and the lock-in effect stayed very real. Sellers with 2 to 3% rate loans still needed a compelling life reason to sell their house. Shifting over to market activity and sales volume. Transaction volume did pick up from the lows, but the rebound was choppy. Certain submarkets and price bands saw a clear jump in activity while others stayed sluggish. The thaw did happen, but it was unevenly distributed. Needed-based moves, marriage, kids, divorce, relocation, and inheritance, those drove most of the increase, not the speculative trading. Also, smaller condos and townhomes were pretty stagnant. Shifting over to prices. Nationally, experts were calling for 3 to 4% appreciation in homes. I always say don't be surprised if Bay Area outperforms. Prices held firm, in many cases moved up, particularly for move-in ready homes in good school districts and commute locations. The region once again outpaced a lot of the country, even while buyers complained about affordability. Steady appreciation supported by high incomes, limited land, and ongoing demand for proximity to tech. Tech salaries were running roughly 20% higher than the national average. Let's talk about trends. Spring last year was again the sweet spot for appreciation and competition, with well-priced listings seeing the strongest offers. Inventory did build into the fall, giving late-year buyers more leverage, but those who bought earlier often picked up both equity gains and later refinance opportunities. The advice of act sooner than later than wait for a perfect interest rate was the best advice given to my clients last year. Now, let's look at new construction for a second because it made some headlines. The incentives and programs offered by builders, they created pockets of opportunity, but the fundamental math did not change. New construction is still a very small slice of our market, and it can't single-handedly solve supply or affordability. It's less than 10% of local sales. Newer builds were helpful around the margins, but not a silver bullet for Bay Area. Let's look at investment market and the rental market. Rent growth did not fall off a cliff. It cooled from its post-pandemic surge, but rents didn't fall off a cliff, and most well-bought properties continued to pencil as long-term holds. A healthier, more boring, more sustainable investor environment. Investors who underwrote conservatively and focused on fundamentals, location, condition, tenant profile, realistic rent growth, they did just fine. Net, 2025 was the year of being healthier, meaning it was more of a balance between buyers and sellers, more normal days on the market and negotiations, less drama, more fundamentals. If 2021, 2022 felt like driving at 100 miles an hour in the fog, 25 felt more like cruise control at 65 miles with better visibility. Not perfect, but a lot saner. Throughout 2025, we've been expecting that Buyers would benefit from increased inventory and less cutthroat competition without seeing a price collapse. That sellers would need sharper preparation, pricing, and marketing to stand out in a more normal competitive field, and that rising inventory would not automatically mean falling prices. And that is exactly what we saw. Buyers had more opportunities to negotiate terms, credits, and contingencies in certain segments, yet clean, well-presented homes still sold quickly and often with strong offers. Sellers who skipped prep or overreached on price sat on the market, while those that treated it like a professional launch were rewarded. The recurring theme of last year was that strategy was more important than ever on both sides, for both buyers and sellers. If you want to see how this healthier market impacted your home, your neighborhood, or your investments, reach out and we'll break down your specific numbers together. Thank you so much for watching, and I'm always here to help you create a better life through real estate. See you next time.